Hello everyone, welcome back to the Excellecore Real Estate channel. I'm going to talk today about something that I'm really passionate about because I can't stand waste. I hate it. I hate waste in any form, and I especially hate monetary waste. So I want to help eliminate waste today on your mortgage. So let's talk about something right now. Mortgage insurance, okay, specifically on a conventional loan. Why is there mortgage insurance on a loan at all? Well, listen, if you don't put at least 20% down when you purchase the property, the lender is in a position where they feel like they have greater risk. If something were to go wrong with the loan, if it were to get foreclosed on, they have risk, and so they want to insure against that risk. So what they do is they have you as a homeowner pay insurance, which is known as private mortgage insurance, or PMI, you've probably heard it called. They'll have you pay that to stave off any kind of maybe them getting caught, again, if it were in foreclosure or something to go wrong with the loan. So, does this private mortgage insurance actually help you as a homeowner? No, not at all. It protects the lender, okay? So as quickly as I possibly can help you get that off of your loan, that's what I want to do. So let's take a look at some numbers real quick. I know some of you might not enjoy math as much as I enjoy math, but if math can make more money in your pocket, give you a better vacation, maybe a nicer car, I want to help that happen. So let's take a look at just a typical scenario. In this area of like Wesley Chapel, Land O'Lakes, and Lutz, Florida, the average sales price of the home is roughly around $250,000, $275,000. So we'll use $250,000 as a sales price for our home. So let's assume for a second that you have a house that you purchased for $250,000. And you did come to the table with 10% down. Now, conventional mortgages generally a minimum is around 5%, but we'll use 10% for our numbers today, which means you put $25,000 down. That means you got a loan for $225,000, and at a rate of 1% per year, a PMI calculation, that would be around $2,250 per year that you're paying to the bank that you will never see again. Now, if we're looking at an amortization schedule, let's say you set up a 30-year amortization loan. So you're going to pay this loan of $225,000 off in 30 years. It looks something like this. You pay a lot of interest at the very beginning, and then at about year 18, you're actually paying more principal than you are interest, and you pay the loan off, and it's all said and done. Well, what we're trying to get to is, based on a sales price of $250,000, 20% down would have been a loan of only $200,000. So that's called like the gap, 20% gap right there, okay? So what actually happens is in your paperwork, you will probably have a set time, and usually it might be around year 6, where you would hit that $200,000 mark. That's all that you would still owe on the property, and the lender would remove the private mortgage insurance from your loan. But that's 6 years. I don't know that I want you paying somewhere in the neighborhood of $2,000 over the course of 6 years. If you do the quick math at $2,000 over 6 years, that's $12,000. That's a lot of money to me. Maybe it's not to you, but I think most people think that's a lot of money. So here's what I'm thinking. If you have a conventional loan and you've been in the house for at least 2 years, the other thing you've got to take into account to create that 20% gap is the value of the home going up. So you are paying it down, but if we can create a 20% gap here and tell the bank, say, I would like you to review the value of my home to see if I am sitting in it, meaning the amount that I owe, at a 20% less rate than what it's actually worth. They will do that after 2 years. I'm getting a lot of requests from like Wells Fargo at the time to see and check in on people's properties to see where their value actually is. Now, based on a house that's $250,000, I'm going to use the calculator here real quick. And you put $25,000 down, so your loan was $225,000. You want to create that 20% gap. That means the property would need to be worth $281,250. Now, You started at 250 value. So you can see that's an increase of $31,250. You say, Jeremy, that's a lot of increase. Well, it's not as much as you might think. The markets around here in Florida have really increased over the past several years. And that realistically is only about a 6% increase per year. So if over the course of 2 years that 6% increase does happen, I would want you to review the value on your home to see if it's maybe worth $281,000. I reviewed several homes that are worth well more than a 6% increase over the past 2 years. But let's just say that you don't, and you continue to pay until the PMI is just going to be removed from your home. 4 years at an average of $2,000 per year, it's $8,000. What would you do with $8,000? Would you set up maybe your kid's college fund? Would maybe you go on a nice vacation with your family, or a couple nice vacations with your family? That's money that can be back in your pocket. So here's what I'm asking you to do. If you've got a conventional loan and you've been in your house for 2 years, you need to be checking in with me regularly on an annual basis to see what your property is actually worth. And maybe it's not ready for you to be able to remove the PMI, but you might be pleasantly surprised. There's several individuals who have had somewhere in the neighborhood of 20 to 30% increases in their value, and they didn't even know they had the value in their home that they did. It's just always a good idea to know where you sit with regards to your net assets. So check in with me regularly. I'll put some links down on the bottom, excellecorerealestate.com. You can comment below. You can message me. Whatever, but get in contact with us. Let me check on your value. It's no charge to you. Check on your value. See where you're sitting, and see potentially if you could have that mortgage insurance. Get that stuff off. Get done with the waste. No more waste. So remember, excellence is at the core of who we are, because we are Excellecore.